Welcome, everyone, to another Market Radar podcast. I hope you've had a great week. Let's take a look at what next week has in store for us. We have FOMC on Wednesday, the big week. It really comes up quick on you. We do have JOLTS and jobless claims Tuesday, Thursday. We'll be looking at those. That's what the Fed is looking at as well. And so I want to go right into it. Obviously, the Fed's going to raise 25 basis points. I mean, it would be a surprise if they didn't. But it's not what they're doing, it's what they say, what Powell says. Do you think Powell is going to be hinting at pausing hikes? Or is he going to be super hawkish and go back to a stance of data dependence and leaving it open for a possibility of more hikes?
I do think so. The Fed's been very vocal with this, in their last dot plots that we saw at the last meeting, right? In terms of where they expect to get their rates to by the end of the year, being about 5.1, basically 5.25. So if they've been very vocal about that, and we're at 4.8 right now. So one hike further, right, that they're going to do on Wednesday, the market assumes they're going to do, will bring us to 500 basis points. And then after that, we're only really one rate hike away from their expectations, the dot plot expectations by year end. So I don't know if he has to be that hawkish, given that they've been so vocal about that 500, basically 5.25 terminal, or their peak rate throughout the rest of the year. I don't think they have to be that hawkish anymore, because they only have one rate hike from where they would be at if and when they do hike rates next week. So I assume they're going to still lean on the data dependency, and they're going to still say that obviously inflation remains problematic. But if we just go back a few podcasts ago, we were talking about the dilemma that they're going to run into as inflation comes in under 5. Getting it down to 5 was the easy part. Now, slow and steady, the fears are going to build of over tightening. It's going to happen, even though we might not see inflation come down. Remember, their policy actions are lagged out by at least 6 months. So they know that if they do too much, they will run the risk of over tightening.
Right.
And
Well, don't you think they want to somewhat be hawkish, since we haven't really seen what they want to see in the jobs numbers? Employment is still hot.
Right, but employment's still hot, but we haven't even hit the terminal yet, right? We're if you go back 12 months, 12 months ago the rate hiking cycle just started. So there's so much lag that has to play out here that the reason why the markets or the Fed has been voicing this terminal rate, and the market understands this, is because the Fed will not just hike to 10%, or 7 or 8%, unless inflation becomes problematic. And obviously, it's very hard for them to get really hawkish when inflation is on its way down. We haven't seen any upwards inflationary pressures yet, to signal that the Fed would even have to remotely think about thinking about being more hawkish at the moment than what the market's already priced in. It's not like we're not even seeing break evens break out to the upside. Obviously, CPI isn't at all breaking out. Now, you can talk all you want about core, but we know core by itself is a lagging indicator. Core is a subset of the actual CPI. So we really pay no attention to core, because in the end of the day, core will lag and then follow headline with due time. So as long as you really worry about headline, you'll get pretty much the whole picture over time. You'll get the picture over time. You'll miss the nuances here and there, but in terms of really where inflation's going, headline will paint that picture.
Right. It really feels like the inflation picture is fairly clear, unless if we get some wild print, some wild higher inflation print.
Right. Yeah.
But now it really feels like growth is what everything is depending on. And that's kind of where the market is struggling to price in right now, is the trajectory of growth.
Yeah, and we're going to go over that in a few moments. But let's go over what happened in the markets this week, right? So the Nasdaq closed up 177 basis points, so a nice green week. It's been bullish trend since mid March. So obviously, bullish trends tend to lead to higher prices. Now, given that it's bullish trend, we do not fight trends. I know a lot of people either out there are looking to or have been already trying to short this. And there's really no reason to do that because bullish trends, again, tend to lead to higher prices. And you'll have to get the exact spot right to get to fade this move if it's going to fade. It may not fade given its bullish trend. So we don't fight trends. We don't do that at Market Radar. We don't actively put capital to work in a position that's already set against us, and that being going short a bullish trend and buying a bearish trend. Those don't make sense, so we don't do them. In terms of where the market is going to go from here, keep it simple. Major indices, NASDAQ and ES and S&P 500, they're bullish trends, so they can continue higher if they want to. Again, don't try and fade it if it ain't working already for you in the trend. Now let's go to bonds. Bonds are still bearish trend. They closed up 93 basis points on the week. While they're bearish trend, they are on the verge. As you can see, we've been flirting with Momo a lot lately in the past few months here, and we are slowly spooling up what looks like it's going to break above and start moving, but we've yet to see it. And again, another thing we do not do is front run the trends. If the trend is bearish, stay away. That's what we're doing. We will do so until that trend flips. Now, bonds are going to need real yields to move with them. If you don't know what real yields are, they are the expected rate of return over the duration of the bond, accounting for inflation. So keep it simple. The real yield is if you take a 10-year treasury, what is the return on average over 10 years, including the expense for inflation, like what you would lose with inflation. So right now, the 10-year treasury is trading at let's go. The 10-year treasury is trading at 3.42%, but the real yield is 1.15%, meaning over 10 years with inflation, you will actually return, based on today's projections, 1.16%. Now, for the bond trade to work, you're going to need real yields to go down. Real yields down, they're inversely correlated to bonds. So if real yields go lower, bonds will go higher.
And they're bearish trend right now, which is a good sign. Bearish trends tend to lead to lower prices, right?
Great start.
So, good start.
Good start. But let's go on to let's move on to the Japanese yen, because I was making some headlines on Friday morning. What's going on here? So what basically happened is the BOJ came out and said that they're still concerned about deflation. Now, what does that mean? Well, obviously, we know the world globally, we're dealing with an inflationary issue. Due to COVID, due to all this stimulus, we're still dealing with the aftershocks of that inflation. Now, Bank of Japan says they're worried more on deflation. They're basically worried more about the effects of deflation grabbing hold and dragging the economy down. They don't see the inflationary risks as of right now. So they said they're going to continue their ultra easy monetary policy, which is their yield curve control and whatnot. I think the market, and we all were thinking when we saw the yen rally off the October lows, that maybe yield curve control was going to come to an end at some point. It most likely will. That's the thing. It's a matter of when, not if. And it doesn't seem like the when is remotely close right now. Obviously, the yen's breaking down. We're actually getting what looks to be the start of another bearish trend here. So again, if you're long the yen, Godspeed. We don't fight bearish trends. Let it play out. And once it goes bullish, the odds flip in your favor. And if it holds bullish, it can continue higher. Until that happens, the yen, with this new bearish trend, can continue sideways to lower. Now, let's go over why this is going on. What's really going on with Japan? So let's simplify this here. I put up a tweet on Friday in the morning, overlaying Japan CPI year over year with the BOJ policy rate. So as you can see here in orange, we have the Japan CPI year over year, and in purple here, we have the BOJ policy rate. So as you can see with the BOJ policy rate, it is at negative 10 basis points, meaning they've been negative for years now. So they are negative. Okay. Inflation was at almost 4.5. Now it's at 3.2. The only problem here is retail sales, if you just look at this, and this is just one metric within the Japanese economy, their 12-month rolling trend on retail sales is a year-over-year metric is now 4.15%, meaning, simply put, their retail sales are higher and stronger than usual, which, if you look at inflation, inflation is primarily driven not by corporate profits, not by all this bullshit that they want to tell you. It's driven by demand, right? If there's demand at prices, prices will go higher, just like anything with supply and demand. And once you peak out demand and there's a supply glut, then prices come down. This is how this works. This is basic economics. So if you're seeing Japanese retail sales really break up and hold to the highest trend since 1991 in terms of a trailing 12-month basis, well, you have to assume that inflation may be stickier in Japan than what the BOJ is currently thinking. So that's something to keep an eye out for. But in terms of what the yen is going to do, again, keep it simple with the trends. The trends will tell you the trends will tell you if there is going to be a significant price move, and they'll alert you ahead of that move. So as long as you pay attention to the trends, you will catch the move before it happens. Almost 9 out of 10 of the times that it does. So just pay attention to the trends. Now, let's go over to the next part or the topic of this podcast, and that's going to be growth. And obviously, the markets are not selling off. On Friday, we had First Republic Bank go into receivership. So that's another bank failure, and the markets are closing in the green. Seems like the markets really don't care anymore about banks failing. Some even joke, if another bank fails, maybe we can get the market to all-time highs. All in all, the markets are being held up by one thing, and that's that positive growth. So GDP came out last week at positive 1.1% for Q1 of 2023. Now, that's basically telling us that growth is still positive. Remember, for real recessions to take hold, we have to have that growth negative. So growth is still positive, so recession is avoided for now. Now, the markets are also not breaking out because of two main factors. One being growth is not negative, but it's also still positive. So it's range bounding markets. And the second one most likely is going to be the debt ceiling, right? This whole debt ceiling debacle, that's going to weigh on markets. I've been saying this for some time now. I think a debt ceiling resolution may actually be bullish for markets to a degree. I don't know how bullish, but I could see a positive reaction happening if we don't rally into it and then sell the news there later. And I wouldn't consider this rallying into the debt ceiling. Obviously, we had the back half of the week was filled with decent moves in the FANG names after earnings, so it helped bolster the market higher. And again, a lot of people were expecting the market to fall apart because of FANG earnings. They thought, oh, this is it for the consumer. A whole bunch of nonsense. In reality, market's still strong. So when I say that one of the two things, two being debt ceiling, but one being growth, what does that mean for why is the market still up with that growth metric? So if we go back and we look at where growth has been in the last quarter, or throughout quarter one and parts of quarter two, but primarily quarter one, growth was much higher than where it ended up closing at, meaning the expectations of the market was thinking growth was going to be was much higher. Our system, which is basically our economic and economic regime model that picks up on economic and market data combined, was able to see this shift in growth ahead of the curve. Now, the market, again, remember, growth being higher and coming lower. The market is watching growth slowly tick lower while still positive, is bolstering the markets, but it really can't get the markets moving because growth is slowly fading. So the markets are range bound, like I said earlier. Now, what do I mean by GDP? Where it is? This is all probably sounds confusing to you, so let's break it down. GDP can be forecasted or it can be viewed through the Fed, which does forecast it through the GDP Now model, and they update their results every couple of days, and you can basically track where the Fed model thinks GDP is going to close at the end of the quarter. Now, what we did here, and I'm going to pull up a chart, we overlaid the market radar system risk on probabilities in green and the GDP Now historical results on a daily value in white. So what is this showing you? What is the risk on probabilities? The risk on probabilities are the probabilities of growth accelerating. That's it. Very simple. Now, what does the GDP now Atlanta Fed line showing you? That's just showing the expected GDP value by the at that point in time for the end of the quarter. So if we look over here, what you'll notice is this is March 2023, where my mouse is here. GDP was at a high, and this was right before SVB hit. And if you or right after SVP hit, excuse me, this was the bounce back. If you notice, what ended up happening was the system, the system risk on probabilities fell off a cliff rather hard and bottomed well before the Atlanta Fed model faded the move, or the model faded the GDP expected value by the end of the quarter, meaning the system is sharp enough to front run what the market thinks already is going to be the quarter end value. Basically, this is a forecasting model, and the system is ahead of this forecasting model. This has its own pros and cons, but you can see even here in 2018, the risk on probabilities start falling off a cliff. Yet the Atlanta Fed model doesn't really see that pain for at least another month or two. And the reason why this is important is it allows us, by looking at the system, due to the fact that the system is sharp enough, to get into positions early enough to capture the move and not be there panicking when the shit hits the fan, or when the rebounds do occur. For example, growth was picking up well before the Atlanta Fed even bottomed. So this is the importance of making sure that your system, or whatever model you're using, if you're using ours or if you're using your own, is sharp enough to keep up with the market and keep the chains moving, and make sure that you're in the right moves at or before they go underway, and you're not stuck riding what some would call right now a bear market rally. A lot of people are calling this a bear market rally. The problem with that is, at what point does your bear market rally become a new bull market? And that's where most people cannot give you an answer. That's why with a system, you can look at it and you can get a finite result. We have finite results. We have regimes that are broken down, displayed on a daily basis, giving us daily direction on where our models think the market should go over the next few months. And all of this culminated, what ended up happening was the market's range bound in turn pushed volatility down into new, I think, multi-year lows now, right? Where VIX is the lowest since 2021. So we're way back to 2021 levels. We're printing 15 handles on the VIX. Now, why is this? Well, remember, the markets are range bound even on ES, and for the month, in the last 4 weeks, ES is up 4.54%. That's a very low number compared to what we were seeing just a few months ago, maybe 6 months ago. In turn, volatility going down is going to improve liquidity conditions. And this is another chart we provide in our daily report. The system stats and all this other stuff that I was just mentioning, that again is provided in our daily report on our website on the member section. And so is the USA Liquidity Risk Index. We have one for the Eurozone as well. These are proprietary indexes. We build them, and what they are indexes that measure liquidity risk. Now, simply put, the higher this goes, the more risk there is involving liquidity. Meaning, the higher this goes, the worse liquidity you're going to see in the market. So up is bad, down is good. This is mid-range, mid 52-week range, right? We have the red line here showing the 52-week low and the green line showing the 52-week high. We are mid to low 52-week range right now. And the long-term average is down in the 60s. So we are still well elevated in illiquid conditions, but we are nowhere near where we were printing in October, and even after the whole SVB collapse in early March. So again, liquidity conditions improving. That's going to be market bullish by itself, because as liquidity and conditions improve, more investors are inclined to step back into the market. So unless we see this start picking up again, it's going to be hard for markets to really break down. We go over a lot of what we think the markets are going to do in the what we have in our Discord channel is, it's called the Ledger, and we post our notes in there as we progress through every couple of weeks. We'll post another note, and what it does is we basically outline for you what we think the market's going to do in the next few weeks, maybe even month or so. And we keep that note up to date. And what it does is it basically tells you what we're seeing through our eyes, which are watching our models, basically our own interpretations of our own models. We spit that out there for you in the ledger. This way, it's all us only. So our other channels, you can talk. There's no fluff in that. It's just straight notes, straight to the point. You can scroll through. They're saved. You can always go back and look at what we said, and obviously whenever we do say something, it's up to date, right in front of your face. Now, in terms of what we've been saying, I'm going to drop a couple of hints here. We have been saying that the stock bond correlation should essentially hold positive if the recession is not deep enough. What that means basically is if the recession does not get bad enough when it does come, what's going to end up happening is obviously the Fed will reduce rates somewhat. Won't be COVID to zero, 3 to 2 or 2.5 or 3 to 0. Won't be like that. But the Fed will reduce rates. And what will happen is the recession won't be deep enough to really outprice those forward estimates at the market, basically outprice the worst case scenario that the market was pricing in 6 to 8 months ago. And markets will go up, and so will bonds through the expected recession and rate cuts. We'll see how that plays out. And obviously, any updates to that thesis will be posted in the ledger for all of our members. Thank you so much, guys, for listening. If you have any questions, feel free to reach out to us on Twitter @TheMarketRadar.